So we got Keith Powell here. He wanted to join us on the podcast. And as I made mention, we're trying to keep things fairly real estate related, but I think talking about the financial arena, it kind of ties into real estate. And I know a lot of what you do is divorce specific, correct?
Which very much ties into real estate.
Right, exactly. So, introduce yourself, tell us a little bit about what you do, and we'll take it from there.
Okay, well, my name's Keith Powell. I'm a certified financial planner and certified divorce financial analyst. I've been in the financial world for 32 years, but about 15 years ago, I niched my practice to primarily working with women and couples as they're going through a divorce to help with all of the financial aspects of a divorce, because a divorce is really about dividing your assets and dividing your time with your kids if they're under 18. So I'm there to help with the division of the assets part.
What made you decide that divorce was the road to travel?
Well, I get asked that question a lot, and it wasn't really a decision that I made. I mean, ultimately it was, but it was, I went to a specialist, a consultant, that he had a niche where he only worked with financial advisors. And of course, he said that as a financial advisor, we need to find a niche. And I had known this for years. I've been in the business probably, 15, 18 years at the time. And so all I could ever think of when I heard that was, let's see, you got business owners, doctors, lawyers, airline pilots. But then after that, I kind of stretched to even think of my next niche, right? He said, if you've been in the business this long, your niche has probably found you. So he had me take out a piece of paper and on the left-hand side, write down my 5 most profitable clients. And on the right-hand side, write down my 5 favorite clients to work with. Well, both of those lists are pretty easy to come up with on the fly, right? And once I had them on the paper, he said, now draw a line and see if there's a common thread between these 2 sides of the paper.
Okay.
The common thread was divorced women. Now, these women had come to me after their divorce and said, I need a new financial advisor. I'm not going to use my husband. So I said, okay, this is my niche, right? Women after they've gone through a divorce. Well, I started mentioning that, and people started sending me referrals, which, first of all, I knew I'd struck a gold mine when I instantly started getting referrals when I talked about it. But they were sending me women, and it was primarily women back then, that were in the middle of their divorce. So I started being involved with mediations and clients that were dealing with their attorneys. And one of the attorneys, actually, Greg Morrison, who's a pretty active attorney here in town, recommended that I go get what's called a certified divorce financial analyst. Now, just like everybody else, I didn't know that certification existed. So I went and got that. And now quite often I know more than the attorneys do when it comes to those mediations. I know. I still love getting referrals for them. But there's been a couple of times where I spoke up in a mediation and saved our clients $50,000 or more just from, hey, by the way, don't do it that way. Do it this way and save a ton of money.
Okay. Well, I mean, with this, in addition to being real estate related, if you noticed on the door, I mean, one of it is empowering entrepreneurs. And one of the first questions that I like to chat about, and you kind of touched on it a little bit, is what is one of the things that you do to generate new business? I mean, all of us, whether we're in real estate or financial advisor, all entrepreneurs are trying to figure out ways to generate business, and I like to share. So what are some of the things that you feel like that you're doing that is helping you generate business outside of kind of what you just described?
Well, you mean outside of podcasts?
Podcast, here we are. This is one of them.
I mentioned to you walking in, this is the 3rd one I've done this month.
That's awesome.
Yeah. I do a lot of networking. So one of the things I do, and this is a plug, is when I got certified, I immediately started looking for, okay, where's the networking group where all the divorce professionals get together?
Yeah.
And I looked around and there wasn't one.
Right.
So I created one called Austin Divorce Resources.
Okay.
We meet once a month at the Santa Rita's on 38th Street, 11:45, second Tuesday of every month. Second Monday of every month. And we've got about 800 or 900 names that are in our meetup group, if you will.
Okay.
But every month we attract 25 to 30 professionals that are either in, somehow related to a divorce. Could be a mortgage person, real estate, but also a financial person. Could be a business valuator, certainly a family law attorney, maybe a therapist. Those are all kind of what I call in that secondary crowd. You need your family law attorney, but then you need all these other professionals as well. And then there's what I call the tertiary crowd. Like there might be a stylist that shows up, or a trainer, because you got to get in shape to date, right?
That's right. Yeah, I mean, it kind of makes sense.
Right. So a lot of people are starting over. So basically, it's a great way though for the people that are marketing their services to individual or a couple that's going through a divorce, it's great for us to find out about each other. I also open it up to anybody that's actually going through a divorce.
Mm-hmm.
They can come and hear us all stand up and give a minute or two about what we do. And a lot of people, usually every meeting will have 1 to 2 people that are actually going through the divorce. And they can share with us about their experiences, or they can just listen to everybody else talk about what they do related to a divorce. Also, I give them the opportunity if they have a question and we finish early. I'm like, okay, well, you got an incredible think tank of, divorce professionals here.
Mm-hmm.
Do you have any questions about your current situation? And if they do, we instantly know, oh, that's probably, David's question, or that's Susie or whatever.
Right.
But there's somebody there that can answer it.
So outside of, just kind of showing up to the group, is there any kind of information online or even on social media or anything like that?
Well, we have a Facebook group, Austin Divorce Resources.
Okay.
We have a website, austindivorceresources.com.
Mm-hmm.
And then, of course, there's the meetup group as well.
I see. And so as far as your business is concerned, I mean, one of the other things that I've been asking people that seems to be generating a lot of good information is like, what are some of the bigger pain points that you're running into in your business, things that, just as an entrepreneur that you run into?
Pain points in my business or with my clients.
Mm-hmm.
Well, the pain points the clients usually come to me, especially if they're coming through divorce, and especially if it's women. I mean, I started my practice or my niche working with women, but it expanded into women and couples because some women were saying, hey, me and my husband are getting along. Can we both come see you? I was like, sure. But primarily I started dealing with women, and I still do work with a lot of just the women on the divorce. And their pain points are pretty similar. They're, that sense of security they get from marriage, that's been ripped out from under them.
Mm-hmm.
And so what I do is I help them get that sense of security back. With Texas, you're pretty much going to get 50%. It's pretty much a 50-50 state unless there's some nuance to your divorce. But I help them understand with 50%, this is what your financial future is going to look like.
Okay.
And I've had to deliver the sad story that somebody that hasn't worked in 30 years is going to have to go back to work.
Right.
I've let somebody know that even though you're working, you really don't have to. So it just depends on what the answer is. But having a clear understanding gives them that sense of security back. So it takes away a little bit of the pain point, from going through that process.
Here's a different way to frame it, I guess. What are some of the things that you wish that you could tell your clients or your potential clients, that you wish they knew before they came to you?
Well, first of all, to come to me first.
Sure.
Because, divorces, everybody sees on TV and they hear stories about divorce that, if you're going to go through a divorce, what's your first step? Call an attorney.
Mm-hmm.
And your spouse calls an attorney and you both put down a retainer. And then they go to battle, right?
Right.
Well, there's about 10 different ways to get divorced. That is one of them,
Mm-hmm.
but that may not be the direction that's ideal for you and your spouse. Again, it depends a lot on how you're communicating. But I say on a scale of 1 to 10, you've got, on one side, you've got what I call a kitchen table divorce. So a couple can sit at their own kitchen table, figure out everything on their own. They can actually go online and get divorced online, and that's the most economical way to get divorced.
Mm-hmm.
Then you've got on the other side 10. That's what I call War of the Roses. Now, if your audience is not old enough to know that movie reference,
right?
But it's a good one. But basically, it's 2 people that are going to go for the jugular, right? They want to just take everything from the other person. So that's a 10. So I come into play when we're at 2, level 2. You can't really do it on your own. You need somebody to guide you.
Mm-hmm.
Then 2, 3, 4, you're communicating. I can guide you through that process. Maybe we get an attorney involved early on. Maybe we wait until we have all the decisions made about the assets and the kids, and then get an attorney involved at the end, just to put it in a decree. Or maybe I've had clients come to me and say, hey, I'd love to use your services. And I look at their situation and look, you might need me at some point, but you need to go see an attorney like yesterday.
Right.
So it just really depends. But the reason I named my company Austin Divorce Planners, it's kind of a play on the fact that I'm a financial planner.
Right.
And there's wedding planners, and now we have divorce planners, right?
Yeah. Well, I mean, that was going to be my next question. Obviously, I know that you specialize in divorce, but that's not all that you do. I
Right.
mean, obviously, you're doing financial planning. I mean, you would take on clients outside of a divorce situation, correct?
Oh, absolutely. I mean, I really spend about 33% of my time on divorce.
Mm-hmm.
About a third of it is what I call retirement, that's sort of the catch-all for a financial advisor. And then the other side is I do a lot of work in the 1031 space and helping clients that are, maybe selling a rent house. Maybe they don't want to buy another rent house. We can move them into a Delaware statutory trust, which is a portfolio of investment assets, but it's 1031 qualified. And they can move out of a rent house and be done with the tenants, the taxes, the termites, and the toilets. And then they can go into something that's more of a passive investment.
Well, yeah, let's talk about that. I mean, that's real estate related, and it's a question that I get a lot of. And of course, I know about it and people are aware of it, but it seems like there's a lot of questions and a lot of just inconsistency in what people are hearing. So I mean, I would love to hear kind of you describe exactly what that looks like, number one, and then number two, kind of explain the benefits to all different types of homeowners, whether it is an investor, whether it's maybe someone who has an investment, wants to buy a current primary, or just all of the inner workings of what that looks like.
Well, the 1031 is typically for somebody who's an investor.
Okay.
That it has to be investment property for investment property, but they can do what's called a 1031 exchange. It's an IRS code where they're basically taking the cost basis from the initial property and just rolling that cost basis into the secondary property. So if they have especially in Austin, let's say they got $1 million house that they paid $30,000 for back in the 80s, right? Or maybe they inherited it at $30,000. Well, that $970,000, if they were sell it, is a gain, and they're going to owe taxes at 23.8%.
Right. So to be clear, again, I mean, not for me, but for everyone else. So this is all designed to avoid any kind of capital gains tax.
Defer.
Excuse me.
Yeah, that's the word we like to use.
Defer.
Not avoiding, deferring.
Understood.
Right. Deferring till the future, or deferring in perpetuity. If you defer, what we do, swap till you drop. If you defer it your entire lifetime, and then your kids inherit their property, there was never any capital gains. They are going to get a step up in basis, and you don't ever have to pay the capital gains.
Good to know. So it's from investment to investment, and we're just kind of deferring taxes as we purchase other investment properties. Is there anything outside of that we can utilize a 1031 exchange for? Or is that really just the gist of it?
Well, 1031s for investment property and investment property.
Okay.
There is another tax code, 453, smaller number, older code.
Yep.
But 453 is the way to defer capital gains. It's by using what's called a deferred sales trust to defer the capital gains on any highly appreciated asset outside of publicly traded stock.
I see.
So you can't do it on, anything that you can trade publicly, but you could do it on cryptocurrency. You could do it on art. You could do it on, and this is where I utilize it a lot, is doing it on businesses.
Okay.
Yeah, if somebody sells a business, typically they have no cost basis unless they bought a franchise, but typically a business owner built it up from scratch, right? So the cost basis is zero, and maybe he's selling his business for $5 million, or even got a referral from a guy that's selling his business for $200 million.
Wow.
23.8% tax on something like that. So we're talking close to $500 million on a $200 million deal. $500,000 on a $200 million deal. Wait, excuse me. $200 million. $25 million.
I've got a calculator in the other room.
$50 million. There it is. $50 million. That's a lot of money to go to the IRS that you could otherwise have stay in your portfolio and continue to earn money for yourself.
I see. Well, take a minute to think about this one. What seems to be, at this point in time, something that's, you're getting right now, not throughout your career, but what seems to be the number one question that you're running into from just your clients that you're getting a phone call on?
Well, is my money safe at the bank? That's a hot topic question right now. Yes, it is. If you don't have more than $250,000 in the bank, it's insured.
Okay.
So if you have more than that, you should move it around. You should keep it at the same bank, but put it in a different name. Maybe have one in your name, one in your spouse's name, one in you and your spouse's name. Each different registration. It's got its own insurance.
And so why is that a fear?
Well, because what we've seen in the increase in interest rates, that has caused banks that are they're giving out loans for the last 10 years, giving out mortgages, let's just say. 4%. Right? Well, now they're paying CDs at 5%. Well, that's kind of making them upside down a little bit. So if they weren't making really good investment decisions and limiting their risk, then they got themselves in some trouble.
Sure.
So, yeah.
And so that strikes fear into people who have their money in banks.
Right.
Again, the conversation between you and I know we know the answers, but this is for everybody else out there that wants to troll and find out information without calling guys like me and you.
Right. Oh, and the next one is, of course, are we going to experience a recession at the end of this year?
Are we?
We either are or we aren't.
I know. My crystal ball's broken.
Yeah, right. So, I mean, a lot of people have thought, I tell you, the ones that thought we were going to go through a recession, they think that the likelihood is reduced at this point, but hasn't been eliminated.
I think they're calling that a soft landing.
That's what we were shooting for.
Right. Well, I mean, that's
I didn't have high hopes.
Same.
But we also haven't gotten the recession yet.
Correct.
We won't know the soft landing until it's either hasn't happened or has happened. You got to get 3/4 past it before you realize whether or not it happened or not.
So you're getting that question a lot, but why do you think that is?
Well, I think people are sensitive to the idea that if you print money, willy-nilly,
Mm-hmm.
then the value of the money, is gradually becoming worthless.
Sure.
So,
And what does that do to my money?
exactly.
Yeah.
Deteriorates how much your money will buy.
Correct. Yeah. Yeah. And so just what is it? The uncertainty, right? You're
Right.
getting calls because of people that are just feeling uncertain.
Mm-hmm.
Yeah.
Right.
Well, outside of that, one of the parts I always do is, I mean, you're sitting with a lender. I know I didn't prep you for it, but do you
Right.
have any questions that you'd want to ask a lender? I know that you probably know a lot of the answers, but
Well, what is a traditional 30-day mortgage running right now?
I mean, today we're seeing stuff in the high 6s, low 7% range. But the truth is that I would feel more confident giving an answer like that maybe 6 months ago.
Mhm.
And the reason I say that is because the one thing that I've been in this business for a little over 20 years. And I've seen interest rates as low as, at one point I was seeing rates at 1.99%. It was wild.
Mhm.
And when I got into this business, and even now rates were in the 6s and the 7s, but I've never seen volatility like this.
Mm.
And so one of the things that always makes me uneasy is when you're quoting an interest rate. I mean, even last week we had kind of a wild dip where if you would have talked to me 2 weeks ago, I would have told you high 6, low 7s. You talked to me last week, I would have told you we were in the mid 7s.
Mm.
And then today we're back. And we just don't typically see that sort of movement in the actual interest rate itself.
Yeah.
We call it basis points, where
Right.
it's like, what's the cost of it? And those basis points can move, but I mean, man, the rates have literally just, and this is one of the things that I think when we talk about housing that really, and it's a good segue from what we were talking about in terms of the recession, because a lot of what drives this is consumer confidence, right? So the level of confidence in real estate because of interest rates, I feel like is at a low because of this volatility. And it doesn't matter if interest rates are going to end up being 7.5% or if they're going to end up being 5%. I think what's really going to allow the market to kind of, become normal, if you will. I
Right.
don't know what other word to use, is when that volatility finally levels off. Wherever it lands, I mean, granted, I want it to land with low interest rates. That would be fantastic for my job.
Low is a relative term.
Right, exactly. Well, good point. I would like them to be lower than they are now, but even if they were to stay where they're at today and just freaking stay there for 6 months,
Yeah.
I really think that would create more consumer confidence, because it is that uncertainty that creates problems in the market. And it does, I was in this business during 2008, the Great Recession and everything along those lines. And I remember that one of the things that was the biggest obstacle of getting things going again really was just consumer confidence. I laughed. There's a South Park episode about it,
Yeah.
where I think it's Kyle takes out a credit card and he pays for the U.S. debt. And the economy just takes off, right?
Nice.
Because he kills the debt, and people start going out and they start buying things because, the U.S. doesn't,
Right.
we're not in debt anymore. And Kyle took it all on, and it's a funny episode, but it's that's obviously a broad stroke, but
Yeah.
consumer confidence is real. It's a big
Mhm.
thing.
Absolutely.
So, yeah, the interest rate thing always makes me nervous though when people ask that question. It's not a bad one, but
Well, it's all
Talk to
about
me next
perspective,
week. Yeah.
because I said it's a relative term. I moved to Austin 23 years ago,
Mhm.
2000. I got 7% on my house, but that was great because that was down from 17% 20
right.
years earlier. So
Yeah. Yeah, my parents are a lot older, and my dad talks about in 1980 when he bought his first house and he got a 17% interest rate.
right.
And then so 7 sounds great.
Yeah, exactly. And it, gradually came down all the way to, next to nothing. But now
Right.
we're coming up, and 7% doesn't look as good on the upside as it did looking on the downside.
Sure,
So it's all about perspective.
I agree. And then how is we talked about high interest rates just in my business. How is that affecting you at all, or is it?
Well, I tell you this, I have been buying a lot of CDs for clients lately, and I
Okay.
haven't bought a CD for a client in a good 10 or 15 years.
So CD being a certificate of deposit,
Exactly.
and why is that?
Well, it's stable money. So, I've got a lot of clients that are, retired and they don't want to lose any.
Mhm.
Well, great. We got CDs that are paying 5.25% for 1 year right now.
And then I was talking with another financial advisor. I'd love your take on this.
Mhm.
So 1 year CDs at 5.25. Where are they at if I buy an 18-month CD, or even a 24-month CD?
They're not that much better.
From what
Yeah.
I've been told,
Yeah.
they're actually worse.
Well, I don't know if it's in the 18 months. I haven't looked because I just go immediately out for
Right.
12. But I know that once you get out to 2 or 3 years,
Sure.
it could be worse.
Yeah.
Right.
I mean, and what does that say?
That's called an inverted yield curve, and it's not
Right.
good.
Right.
It usually says there's a recession on the horizon.
Correct.
Right. In fact, it has never been wrong. So let's go back to that recession conversation.
Sure.
Inverted yield curve, recession to follow. Don't fight the Fed. That's another quote that I've been reminding people of. Whenever the Fed's increasing interest rates, that typically means that there's going to be a downside of the stock market in the near future.
Yeah.
Define near. That's another relative term, though.
Correct.
Right.
Correct. Yeah. I mean, like I said just a few moments ago, I used to feel like I had a pretty good, finger on the pulse of what was, to come. And I'll tell you, the last 12 to 18 months has definitely tested me. And I'm telling everyone, my crystal ball's broken.
Right. Well, buying a house is different than investing in the stock market.
Of course.
You
yes.
buy a house when you need a house. If you just moved to Austin because of your job, buy a house. But if you're trying to trade on the stock market, depending on what's going to happen in the future, nobody has that crystal ball. Even
Correct.
if it's working, it's not really working, right? So you're supposed to set up a plan and then just stick to the plan. And
Right.
the only time that you change that plan is because maybe you've gotten older now and you need a less aggressive plan. Or you've got a short-term goal, like I want to start a business in 5 years. Okay, well, that's different than if I want to retire in 25 years. Two different strategies with the money.
Right.
So,
Well, here's one of my questions for you. And I as a lender and as a real estate agent, we want to sell homes, we want to do loans. But one of the number one things that we, kind of talk about with our clients, and we ask them, do you have a financial advisor? And so I want to ask you as a financial advisor, if you had a client that currently we'll start with renting, and they do not own a home, and I come to you and I say, Keith, I don't own a home. I've got some money invested with you right now. I'm thinking about buying. What are you saying to that client? Because as a client, I'm of the mindset of I want to make sure I'm buying at the best time.
right. Well, my first question is, how long do you plan on owning this home?
At least 10 years. I've got, I want to get married. I want to have kids. I want to do all the things.
Well, I definitely think if you're going to have it 10 years, anything over 5 is usually a good idea to buy as opposed to rent.
Okay.
So you got to be able to answer that question. If you're like, I don't know,
Right.
well, then maybe you should stay renting if you
Sure.
don't know. But if you think you're going to be in the same place over 5 years, then it's typically better to buy.
Okay. And the reason I asked that question is, once again, a client contacts me and asks me, do you think it's a good time to buy? And I say yes. I think there's a little bit of well, of course you would say that. You want to
Right.
do my mortgage.
Oh, yeah, there is.
And so I do encourage people, if they have a financial advisor, I say, don't take my word for it. Go ahead and contact your financial advisor. In fact, I'd like his contact information because that's one of those things that, for me, it's always good to get in front of other financial advisors, and it's good to have everybody who's kind of on the same team working together. And I've yet to find a financial advisor that would say to somebody who's renting, hey, and again, good point, if you're going to be in the home for a short period of time or you don't know what the heck you want, well, that's kind of a one-off. Most people
Right.
that are ready to buy are pretty confident. They know what they're going to do. They're going to be in the home for the next few years. I've yet to find a financial advisor tell any of my clients, like, right now is a horrible time to buy. Wait, because maybe housing prices are going to go down, or maybe interest rates are going to go down. I mean, what are your thoughts on that?
The reality is nobody knows.
Sure.
So, and plus, this is Austin. I'm
Right.
sure your podcast is getting out there further, but we've got companies moving here in droves, just to Texas, but Austin especially. Plus, we've got the supply of homes is way down, and demand is continuing to go up.
Right.
And so, if it's going to go down, why is it going to go down? Maybe if the whole country enters a recession, we might get what's called a sympathy drop. So like Detroit is losing home values, right?
Right.
But that does, and in Austin, if the whole country's going down, maybe Austin home values go down a little bit, but there's really no reason for that other than what we call sympathy, and then they'll come right back after that. So we have a strong economy, probably over the next 40 years, and that means a strong housing market for the next 40 years, especially with low supply.
So as a financial advisor, would you agree that buying a home right now and either hoping that interest rates go down, which will allow you to refinance, right? Because no one has control over interest rates. I don't have control over interest rates. No one really knows. So purchasing a home, obtaining home ownership, hoping that rates go down and refinancing, and worst case scenario, if they don't, then you definitely got in at a good time.
Right.
I mean, is there anything outside of what I kind of mentioned that you would say, well, you've got to think about this?
Well, I love real estate just as much as I love liquid assets. So I would say, even if you're going to be here short term, maybe get a house and then you rent it out if you move.
Okay.
And then buy another one wherever you go.
Okay.
Lenders seem to be getting a lot better at taking in rental income, even though you don't have a rental history.
Mm-hmm.
They'll immediately say, well, if you're going to leave that house behind, you can turn that rental into rental income and use that to purchase the next house.
So you don't think real estate is a bad vehicle to invest in?
No, I've even got, if people don't have real estate in their portfolio, I will put it in their portfolio through alternative investments.
Good to know. Good to know. Anything else that you would say as far as, and again, I'm trying to do this to, for lack of a better term, dumb it down for the audience and everything along those lines. Investing in real estate is a good idea in terms of accumulating equity. I mean, do you have any stories of individuals that have invested in real estate, experienced good things? How does that work?
Well, real estate typically is going to beat inflation.
Mm-hmm.
It's going to certainly keep up with it, but it's probably going to also beat it. And that's on a national level. In Austin, I think we're going to do a lot better than inflation. We've been averaging, 7%? Maybe 10% in some years.
I mean, one year we were at, I think 2020, they said it was 15.
Well, I like to think of averages, but
Sure.
still, we've been averaging 7% for 25 years. So,
Absolutely.
And I don't think that there's any end to that in the near future.
Mm-hmm. And you need a place to live.
Right, you do. So some people say you're throwing your money away if you're on rent. So
Right.
Stop doing that.
Sure. And again, I mean, I'm asking these questions with the intention of, a mortgage guy wants to sell a mortgage. A real estate agent wants to sell a home, to chat with a financial advisor who kind of doesn't have any, there's no skin in the game for you to say to a potential client, hey, real estate is a good opportunity outside of wanting what's best for the client financially.
Well, real estate is a part of a diversified portfolio.
Correct. So what does the portfolio look like? I mean, I know that it depends, like you said, based on your age and your goals and everything along those lines, but what are some other things outside of real estate and the stock market that you're seeing people investing in that are good options?
Well, I just ran across a deal this week, actually, where you can invest in 18-wheeler trucks.
No kidding.
And you're basically going in with a company that is going to manage the trucks and fill the trucks and drive the trucks, but you're going in on the investment of owning the trucks. And then, of course, you'd get a percentage of what the trucks return. Now, there's risk to that because you don't know, we're going to have another COVID.
Right.
There's lots of different risks, but the returns could be quite high.
Mm-hmm.
But on an investment like that, you're also going to sell these trucks 5 years from now. So you're not going to get your entire investment back. But hopefully you would have gotten so much return during the time that you owned it that it more than makes up for the depreciation of the actual vehicle over the course of time that you owned it.
That's a good one.
Yeah, so that's pretty out there. It's a little different than, owning real estate, or I've got clients that have hotels, storage facilities, apartment buildings. A lot of that is kind of in the real estate market. This is something that's a little more alternative.
So you're doing more than just your typical stocks, bonds.
Oh, yeah. Well, I don't like bonds these days because, as interest rates continue to go up, the value of the bonds are going to go down. So let's think outside the traditional box of stocks and bonds and go stocks and something else and other,
I gotcha. So I think we kind of already answered this question, but I'll open it up to you one more time just in case it's different than what I'm thinking. I always ask people, if you have an avatar, right, that you're looking for, what does that person look like? I know you kind of mentioned that it's, divorce, women. Is that like the ideal client for you, or what does, if you could just paint a picture for me of exactly what this individual looks like? So for example, for me, I really enjoy first-time home buyers. I agree with you. I typically, for one reason or another, seem to work with women more than I do with men. But first-time female homeowners are really one of the things that I find that is the bulk of my business. I enjoy working with them because they ask a lot of questions, and so I don't kind of get myself in trouble for maybe over-explaining. And then we never run into an issue where, sometimes I get stopped, right? Like, hey, buddy, I've bought homes before.
Mm-hmm.
I don't need you to,
Right.
I get it. And then all of a sudden, once something comes up that they don't know, it's like, I never had this happen. What's going on, So I do like the first-time home buyer, right? What does that look like for you?
Well, there's really three because I've got three specialties,
Sure.
right? So when it comes to divorce, ideally, a woman or a couple that's going through a divorce, higher the net worth, the better, right?
Sure.
I actually recently got a couple that was worth about $3 million divorced between me and the attorney. They paid $7,000. That is
That's unheard of.
ridiculously inexpensive,
Yeah.
right? So then also, when it comes to retirement, somebody who's actually retiring, they've got a 401k, maybe it's $1 million or more, and now they have the opportunity to invest in some of these other types of investments I talked to you about. Then on the real estate side, it's an investment owner that is looking to sell their property but doesn't want to pay the taxes. A lot of people don't know that there is a way, this Delaware statutory trust I was talking about, a lot of people don't know those exist. And so I was just actually met with a client.
You mean defer the taxes?
Defer, right.
Right.
Sorry. So I just met with a client this afternoon, and he's selling, $400,000 property out by Tesla. It's probably going to sell pretty quick, right?
Yeah.
But he was sitting there trying to figure out a way to avoid this, what turned out to be $92,000 in taxes. And just, he talked to all kinds of people, and everybody's like, well, it's capital gains. You got to kind of pay it. And I was like, no, we don't have to pay it. We're going to, actually invest it in some land up in Dallas that is immediately being leased back by the person or the company that you're buying it from. And then they're going to buy it back from you, 3 years from now. So it's going to pay out 7%. He loved the idea, and it's going to defer all of that tax. So he's going to have $92,000 extra dollars earning 7% than he would have otherwise.
That's awesome.
And at the end of 3 years, we have the option of doing another 1031, or you can take some of the money and pay some of the capital gains, or you can take all of it and pay all of the capital gains. But he'll just end up continuing to probably do it and do what we call swap till you drop.
Okay. Well, I've got two more questions I want to ask you. But before, is there anything else that you that you want to ask me? Anything you need to know as far as lending, or anything I can answer?
Well, how about this? How long, if you did buy a house and you're going to maybe make that your primary residence, how long do you really need to live in it before you go out and say, okay, now I want to buy another one and rent that one out and kind of keep doing that?
Yeah, I mean, so depending on the type of loan, typically you're going to need to be in it 1 year.
Okay.
So if you're in it for 1 year, we see a lot. I have a ton of people that do that, and then from there, depending on what I encourage people to do is, there's a lot of things they call in terms of the house hack. I'm running into that a lot with multifamily, and so one of the things that we run into that I don't think a lot of people talk about is that FHA is going to allow you to purchase a duplex as your primary residency with only 3.5% down. And that's great, and it works. The problem that we run into a lot of times is that they want to do it again a year later, and if we're going from FHA to FHA, we can't use the rental income on that departing residency. So we run into a debt-to-income ratio issue. If we're doing things through a conventional loan, we can. And so when we get into the duplex stuff, a duplex is going to require 15% down going conventional. And right now, it just seems to be so popular to purchase these duplexes because they're income-producing properties. You can live in one and then rent out the other. I kind of have a tinfoil hat theory about it, is why they're becoming so popular. I can't prove it, but I feel like counties have raised taxes so much recently that these people who have done this, they are getting crushed with taxes on these duplexes, and now they want to unload them. So real estate agents are like, how do we make this sound sexier?
Right.
That could be crazy. I don't know. But if you're doing this with single-family residencies, it's a whole hell of a lot easier because you can purchase these single-family residencies going conventional with anywhere between 3 to 5% down, and you can use the rental income from the departing residency. You don't even have to have a lease. We can go ahead and just have an appraiser go out to the property, give us a general idea of what the house is going to rent for just based on market, just market rents, and we can use that as future income, if you will. And so it's going to help drive your debt-to-income ratio down and everything along those lines for qualifying purposes.
Okay. And are you seeing a lot of, I don't know if you run across this in your business, but are you seeing a lot of corporations that are actually buying houses these days?
So most of the corporations that are purchasing properties are doing them in cash.
Yeah.
So they don't need me.
Well, but what percentage of sales now, do you have any statistics on what percentage of sales are going to corporations?
It's interesting. To be quite honest, I would say no. I mean, obviously we could research that, but I would think real estate agents probably have a much better idea of what that looks like. But I know where you're getting. I mean, you're hearing about these corporations purchasing up properties and doing the things. BlackRock is one of the companies I know that they've talked about that's purchased a lot of residential real estate. I do not know what the percentage is, but what I do know is I did hear a statistic. It was last year, and it was about kind of recessionary information, is that when, this is on the lending side, when I believe the number is something just slightly over 20%, when we'll just call it 20 for now, but when 20% of the loans that are out there are investment property loans, that's typically kind of a tipping point for what scares, people like the Fed and things like that. And what I've been seeing with Fannie Mae, this is one of the largest investors for residential real estate, Freddie Mac. They have been getting really, really tight on the parameters in respect to what they're willing to do and allow for investment property loans. Interest rates have become extremely high. And then in addition to that, the costs that are associated with getting these loans, which are not being charged by originators, that are being charged directly from Fannie Mae, they've gotten very expensive. And the speculation is the fact that there's a lot of speculation of potential recession, which is going to drive down interest rates. And so as an investor, it doesn't really make sense to give this really, really good interest rate to somebody that's going to end up just refinancing it. So you want your money today, right? So it's like, hey, we'll give you 7%, but we want a 3% origination. And it's not origination, it's from Fannie Mae, of course, but they want 3 points on the deal if it's an investment property because they're confident you're going to end up just refinancing it anyway. So this is what's creating this volatility and all this confusion with why is this loan so expensive? It's been really tough dealing with investors lately.
Well, I have another question about your volatility. So you said that mortgage rates are going in the high 6s or low 7s right now. Are they baking in the fact that the Fed's probably going to raise interest rates 2 more times?
I think so. I think that all of the Fed stuff is pretty baked in. I think what the problem that we're seeing with the volatility is that we're talking about raising rates and doing all of these things, but we're seeing so many what is technically considered to be positive, data points, right? Like jobless claims, they're lower than expected. I mean, consumer spending, it's like the average American just won't stop buying stuff.
Well,
right?
That's part of the reason they're increasing interest rates because
Right.
they want to see that stop.
Exactly.
And they want to see unemployment go higher.
And it's like they just can't do it, right? It's like they want to continue to do it until something breaks is really what it feels like. And I think a lot of it comes from, I think it's twofold. I mean, you said it yourself, was it $41 trillion that you pump into the economy? You just print money.
Right.
And so people have money, and then I hate saying what I'm about to say, but it's just a reality. It's almost like people will burn through every single dollar they have, and then when they're completely out of money, then they'll start using credit cards. And I'm not like directing this towards like the mother with 3 kids who's putting food on the table. I'm talking about people buying furniture, cars, clothes, things that, aren't really necessities. Like when you look at the actual data points in regards to what we're tracking in the economy, like it just won't stop. People just will not stop spending.
Well, it'll stop eventually.
Right. Well,
because what goes up must come down.
Agreed.
Right?
It's just I personally am surprised at how it is continuing to keep going. And maybe that's just because of, what I've done for years. And I look at credit reports and I see all of these things. So maybe I'm just a little more conservative when it comes to money. But like just the fact that people just won't stop spending it's wild to me, because I know it's not money that's like, we're literally watching credit card debt. I mean, I know for a fact, statistically, we have more credit card debt in the country right now than we've ever had, right?
Probably coming out of COVID and big time responsible.
Well, and at one point, coming out of COVID, we had the most amount of savings. That was another statistic. More Americans had more money in savings than they had ever had. Now, it's a debatable topic as to whether or not that's because of, inflation. Like, well, yeah, sure, you have more money, but your money's not worth what it was because we just printed money. But you had more savings coming out of COVID, and then flash forward to like 3.5 years later, or 3 years later, and you have more debt now. And I think it just goes to show you that the average American will not only blow through all of their money, but then they will turn to credit cards. And again, I feel terrible saying that because I just know there's someone out there that's like, you don't understand. I'm a single mother, 3 kids. I work 2 jobs.
Talking about them.
That is not who I'm talking about. That is not who I'm talking about. Believe me, I see the credit reports. I see the spending. Like, here's a wild statistic. At one point in time, I remember hearing the stat that McDonald's had more real estate than the Catholic Church, right? And that was like, what is it, Roy Kroc? That was like Roy Kroc's thing.
That movie,
he wasn't buying the McDonald's really for the franchises. He was buying them for the real estate. And that always kind of intrigued me, being in real estate. And then I just recently heard that there is more land in America right now that is being taken up by storage facilities than any other type of real estate in the country.
Wow. Okay. One individual type of real estate. Well, of all the storage facilities, here's another statistic I got last week. Of all the storage facilities in the world, 88% of them are in the United States.
Yeah, well, and so
And we're using credit cards to fill them up.
that's what I mean. Like,
Right.
that's my point. Like, I didn't just start spitting these statistics for no reason. Like, we just buy crap.
Lots of it.
It's wild, man. It's
Mm-hmm.
wild, and it's just, it's kind of fucking sad.
Well, as long as you continue to have a job that's increasing in pay, and you're planning on paying these credit cards off at some point with this additional money coming in, okay. But
Right.
if you are not 100% stable in your position that you're going to have this money, you're going to be upside down at some point.
I just don't understand how people convince themselves, and I know people like this, that they convince themselves, like, you go to Target and you need you need a new live, laugh, love sign or something
Right.
like that. You know what I mean? And
Right.
then, like, it's just the things that we convince ourselves that we need that are literally just things.
Totally.
And, like, how many T-shirts do you need?
Well,
Right?
that is one thing that I've read about younger generations, Gen Z.
Mm-hmm.
They're more about buying experiences. So they're much more likely to go travel to Indonesia than
Right.
they are to buy the live, love, laugh.
Well, I hope so, man, because as much as, even that is not an investment in terms of, financially sound, at least you're getting an experience, and, like, you can't take that away.
It does make you a more well-rounded person if you're going to get out and travel as
I
opposed
totally
to stay in your
agree.
little bubble, right?
I totally agree. No, I definitely, and I'm always, I had somebody say to me, as far as like vacations and things like that, I've watched people going broke with experiences too. I mean,
Right.
too much of anything is a bad thing.
Right.
Because one of the comments that was made is that a vacation is the single most, you can't resell it. Right?
Right.
Even Live, Laugh, Love can be put on Facebook
true.
Marketplace.
Right.
It is a 100% like deficit making it's the opposite of an investment.
Unless
but
you film the whole thing and put it on YouTube and
there you
monetize
go.
it. There, okay, right.
Clip for everybody out there. Monetize your
Experiences.
vacation. But no, I agree. I mean, I'm a huge experience type person, but I am also mindful. It's like, because again, I literally I've got some names in the back of my head right now that are just that have just broke,
Right.
but have a ton of experiences,
Oh yeah.
and that's not a place to be either.
Well, unfortunately, they don't teach financial advice in
Right.
in high school, middle school, any school really.
Mm-hmm.
So it's unfortunate, but I do recommend some classes, some books. You get out there, educate yourself, because I was working with a couple today, government employees, basically not making a ton of money, but they're retired. They're in their late 70s now, and they're worth over $1 million.
Mhm.
And I told them, I said, you're top 1% of the world.
Yeah.
When they're talking about the top 1%, they're talking about you. And they were
Right.
just blown away by that.
Well, and with the financial literacy thing, this is something that's super interesting to me, and I've talked about this before. If you run into somebody and you say, hey, I don't know anything about cars. I don't even know how to change a tire. Nobody really looks at you funny, right? And if you were to say, I'm not very handy, I couldn't build this table,
Mhm.
right? I've got, like, no one bats an eye. But if you kind of say, listen, I don't understand money. I don't understand real estate. People will not this drastic, but like, you get shamed, right?
Right.
And that's what kills me. It's like, everybody makes there's no education, there's no financial literacy, but then at the same time, we almost like shame people for being financially illiterate.
Right. That's why a lot of people are embarrassed to hire a financial advisor.
Well, that's why I'm doing these podcasts, to
Right.
be quite honest. It's like real estate's the same way. Everybody knows everything about real estate. Just ask them,
Mhm.
and everybody knows everything about, interest rates. And I understand that, but, they don't. They don't. And then the people that are willing to admit it don't want to admit it because everybody acts like they know it. And so this is all designed to get people like you and I out there so that people can do their trolling behind their computer and get these little tidbits and go, okay, it's like having someone in the room, and hopefully after reviewing some of these things, they feel comfortable and confident enough to reach out and say, hey, I saw some of the things that you were talking about. That was great information. That sounds like me. Let's get a cup of coffee.
That's great that you're getting this out there.
That's the plan,
Yeah.
man. Anything else you want to cover?
I think that pretty much covered it. Like you said.
Anything else we don't know about you that we need to know?
But let's just stick to the business stuff.
Fair enough. Well, the last thing I always end with is, man, look in the camera, do your elevator pitch, and we'll.
All right. Well, again, my
it.
name is Keith Powell. I'm a certified financial planner, certified divorce financial analyst. I've got it's broken into two businesses. You've got AustinDivorcePlanners.com, and then my financial side is AustinWealthSpecialist.com.
There it is. Call the man.
Matt.
Talk about money.
All right. Thank you.
Thank you.